Howdy, Jacob here. Today we're looking at the Andersons company in the consumer staples distribution and retail industry. 1.75 billion market cap on 2 billion enterprise value. They operate in trade, renewables, and nutrient and industrial sectors in the United States, Canada, Mexico, pretty much globally. And growth for the last 10 years has been very impressive. There was definitely one year where it grew uh, like crazy after declining for 4 straight years, and then the last 2 years prior to last actually was decline, but 2 years prior, crazy growth. So, I mean, just a very weird growth business here. I want to presume these are acquisitions. So let's look at that. So we're seeing a big acquisition here, big net acquisition. It's not even that big, but solid net acquisition, 77 million, 15, 14 million. So it looks like when they make acquisitions, I mean, they buy businesses that are producing crazy revenue. But the thing is, their operating margins are not good. We're looking at mid to low single digit gross margin, which means cost of goods sold is digging into 90 to 95% of their revenue. And then operating margin is an extra couple percent to where they're barely producing positive operating margin. So, I mean, again, balance that conservatism with your own investment purposes. Because obviously, if you were to invest in a consulting business, a technology company, you're going to have way higher margins here to where you're going to have a lot more margin. Where here, if you have 1% operating margin, I mean, a couple things increase in price a little bit too much. You're not able to increase your pricing power on the revenue side, and now you're not producing operating margin. That's just positive operating margin. It's just crazy. So some other things to know. I mean, return on invested capital is low single digits. You're really not getting money returning it. So that returning it back into the business. So this dividend makes sense to me. Cash flow has negative cash flow here. I mean, it's very cyclical. I mean, sometimes you're producing some cash, sometimes you're not. This last year, they produced by far the most that they've ever produced of the last 10 years. So, I mean, on an average basis, I don't know, $200 million. And they have 563 million debt, 71 million short-term debt, 644 million cash on hand. I mean, the balance sheet's really not a big deal to me. I'm pretty comfortable with that. But yeah, I think that they've produced, they have produced the greatest free cash flow earnings they have over the last 10 years. So can they keep it going? I just don't know the business well enough to, so I'm going to be pretty conservative with my investments here. So that dividend of 26 million aggregate is pretty small, honestly. I mean, it's a cyclical business, but it's pretty small in relation to their 5-year average. So we could probably increase that. They've been increasing that 2%. I feel good about that. Let's do that. And then for revenue growth, I mean, maybe 3 and 13. I mean, I think that inflationary growth seems pretty reasonable to me. And, geez, this is crazy. So let's do 0.7% to 1%, which sounds kind of wild to me, but share change. Were they buying back any shares? So stock-based compensation, 7 million. Share count dropped a little bit. I don't think that's making any dent, so let's just go flat here. So we're saying the company needs to fall a little bit more than in half to get to the price we're looking for. This definitely isn't the sexiest business I've seen, and definitely not one I'd be pouncing on. I'd need to get this really freaking cheap. And right now, we're definitely not there. So I do hope you enjoyed the video, and have a great day.